Greetings guys, I welcome you in this wonderful video. So I'm just gonna be sharing with you like ways which you can minimize your risk as a volatility index trader. I know from experience that it can be really difficult to like trade and be successful consistently when it comes to V75, but I just have few tips for you, few simple methods for you that will work and that I have proved that they worked for me, because these are just some few tips that I took from my notes which I wrote like few years back when I started trading volatility indices. So firstly, the worst thing that we do as traders, I know that majority of us as retail traders, we fund with very small amounts, né? But then the problem or the mistake that we usually do is that when we fund with that small amount, let's say we fund with $20. When we fund with that $20, we just put it all away in the market. What do I mean? Meaning, when you fund that $10, you find yourself opening a lot size like of 1, lot size of 2, meaning you are now risking everything. You are risking the entire amount from one particular position in such a way that, let's say, let me just make an illustration here. Let's say you found the market going down here, né? Let's say you can say that, okay, it was on your high there or on your resistance, and you decide to sell here, né, on this red candle here. So when you sell, the market first starts to go up, and when it goes up, because you have used a bigger lot size, you find yourself being kicked out of the market. Your account is blown by just a very small move of few points, and then you're kicked out of the market, and then the market continues to go on your favor. Why? It is because you as a trader, you decided to take your entire amount. Even someone can say this is a very small amount, I cannot divide it. Yes, you can divide it. The lot sizes, they are being decreased. There are lot sizes which can allow you to risk less than you can in terms of risking your entire account. So here you find yourself risking the entire amount from just a smaller move. What you should do as a trader, just give yourself few chances. I don't say that use a very small lot size, but give yourself at least few chances, maybe 3 chances, maybe 4 chances, depending on your risk reward, or on your states. When you try to like observe your history, how profitable are you, how good in analyzing the market. So you should risk based on that. Now, for an example, you can divide this amount like into 4. Let's say in each trade you're gonna risk 5, you're gonna risk 5, you're gonna risk 5, you're gonna risk 5. So you know that you at least have 4 chances. And as a trader who knows what he or she is doing, you know that you can't just lose all of those chances like in a successive manner. So give yourself few chances, divide your account, no matter how small it is, divide it and give yourself chances. And that way it will be not easy for you to blow an account, because what happens here in volatility indices is that you can try to buy here, and then the market goes and it kicks you out. You try again, it kicks you out, and then you try to buy again, you make a lot of money. So you can see that you're risking bits and pieces of money, and then all of a sudden you make a lot of money. So that's how you should look at it. Just try to risk less, and then when you make money, you'll make more. So don't just put all your money in the market on one opportunity. Don't bet on one opportunity. It's gonna mess up with your account. Another very important thing, what we do as traders, what we do is that because we are scalpers, when we scalp, we usually don't apply stop losses. We usually don't apply stop losses, which is not a good thing. If you are scalping, even if you are sitting in front of your chart, it doesn't mean that you shouldn't apply a stop loss. You can leave a take profit. A take profit, there's no problem about it, but a stop loss, you should make sure that you put it there. Why? Because if you don't put a stop loss, what you will say as a trader, you will begin to say, let's say maybe you are trying like to buy here. Let's say you were thinking that, okay, the market was correcting here. You're thinking that, okay, this was a corrective wave, and then when this corrective wave is broken, you decide to buy here. Let's say you buy here, You don't put a stop loss, or maybe not here, but somewhere around there. Let's say you buy somewhere around there. You don't put a stop loss, and then the market starts to slow down. You watch the price, you think that, okay, no, it's still gonna go up. It goes down, you say, no, it's still gonna go up. It goes down, you say, no, it's still gonna go up. And all of a sudden, your account is blown. Why? Because when you observe with your eyes, you can see things that are in flow with what you believe, yet it is not true. You can see, like, you can say, no, the market is gonna bounce here on this area here, because you are trying to defend yourself. You are trying to motivate yourself. You can see errors which are not realistic. You can say, no, the market is gonna slow down here. It's just a fake out, and then they'll come back in. No, you shouldn't do it that way. So make sure that you apply a stop loss. It is always there. It will protect you no matter what. And one other important thing, as a trader or as traders, you should make sure that you have a very, very simple yet working strategy, a very, very simple yet working strategy. So I'm gonna recommend some few strategies that I posted in the past here in this channel. So you can check on the top corner. On those cards there, you'll see some recommendation of some of the strategies that I posted there. You should have a simple strategy, and you should follow it no matter how. You should have basic rules in place, rules that you will follow, rules that you will trade with, that will help create order and increase your success as a trader. And then one last important thing is that as a trader, make sure that you don't trade frequently. Don't trade frequently. You can, like, divide maybe your time. Let's say you want to trade, maybe you want to trade March, or you want to open a lot of trades in a day. You can divide your time and say, in the morning I'm going to trade for an hour, and then in the afternoon again I'm going to trade for an hour. Meaning you're going to specialize, or you're going to dedicate that hour into, like, scalping, maybe using 10-minute or 5-minute time frame, opening and exiting your trades. And then all the hours you are not trading, and maybe you trade again in the evening, like for that particular hour, you scalp, you open, you close, and then all the other hours you are not trading. It helps a lot, guys. It reduces pressure. It helps to give you time to learn, to give you time to understand, and also to, like, do your best when you are trading. Because if you are, like, trading for 10 hours a day, you will find yourself opening trades that you are not supposed to open. So when you decrease it into 1 hour or 2 hours a day, you will find yourself taking high quality trades only because you know that you've got limited time. So thank you guys for watching this video.